Hello and welcome to the Inside Track. My name is Kyle Caldwell. I'm Deputy Editor of Money Observer, and today I'm joined by Richard Pease, Manager of the CRUX European Special Situations Fund. So Richard, to start off with, I was hoping that you could give a bit of an update in terms of recent portfolio activity.
Yes, I think what I'd firstly say is that we don't tend to trade a lot, so not much tends to change. Having said that, sometimes companies get too expensive, and so we do tend to top slice or sometimes sell on that basis. And an example would be Sika, which is a Swiss-based, I suppose, building materials business, which has had a tremendous track record. Another stock which we've actually sold is a company called Elior, which was is a French catering business, which we rather gave up on. We've added one or two things too. I think at the end of last quarter, the market got very emotional, and we had a lot of opportunities. And I think we added to Pease, which is an outsourcing story, which is French-based but quite European-wide. We've added to another UK stock, Equinity, which was again very sort of beaten up, I think very undeservedly last quarter. We took advantage of that. And we've just touched on one or two cheap cyclicals. We tend not to be overly exposed to cyclicals, but sometimes valuations are very attractive. And so we added a bit to, we bought a small position in a packaging business called Smurfit Kappa.
The way you invest, you like to look at mid-cap companies. Does that draw you to particular sectors, or is it very much on a case-by-case basis?
What we tend to do is avoid the sort of capital-intensive, politically at-risk and regulatory at-risk sectors such as, I suppose, telecoms, utilities, I suppose, those sorts of sectors which, I mean, big oil is another area which are very capital-intensive. And I think our concern's always been that it's very hard to get a decent return on your capital. So we tend to avoid those. We would tend to be much more focused on the service-driven businesses which have much higher returns on capital. I mean, our return on capital as a portfolio is 25%, the market is 13%. I think it's, I mean, longer term that does actually help in terms of performance.
From a macroeconomic perspective, Europe has a lot of problems, and it's been quite unloved for a number of years now by investors. What do you think needs to happen for sort of investor perceptions to change?
Well, I think you're completely right. It is definitely unloved. And I think what we would sort of say, we've never tried to actually sell you Europe. We've tried to sell you good businesses born in Europe. I mean, what obviously they do afterwards is what's important, not where they're born. And I think Europe has got some challenges. The world has challenges at the moment. Obviously, there's lots of nasty headlines, whether it's Trump's trade wars or whether it's just anemic economic growth or just ugly politics just generally. And so we have to sort of live with problems. But I think it's not a new thing. If you look down the mountain and look at what's happened over the last 10 years, we've had all sorts of issues, from a financial meltdown to an industrial meltdown in 2009, every kind of hideous something happening in emerging markets and Ebola, all sorts of things. And actually the good companies have actually continued to grow. I think that's what people should remember. And very often the best time to invest is when it's not as fashionable. And certainly we think that the sort of businesses that we have can actually to some extent make their own luck, and whether it's good bolt-on acquisitions which is synergistic or just taking the other guy's market share. And I think that is what really drives our portfolio. But you're right, headlines are a bit off-putting, but that's probably where the opportunity is.
You mentioned earlier a couple of stocks that you've been recently buying or looking at. I was hoping you could highlight a stock that you've held for over a decade since you've been running the fund.
Yes, I think the stock that would spring to mind, which is a good example, is a company called DCC. Effectively, it's an Irish-based conglomerate with a real focus on return on capital. It's a distribution business, essentially. They do things like energy, healthcare, IT. And it came out of private equity many years ago. And I was actually quite impressed, but the guy who actually started it, a guy called Jim Flavin, still has, I think it's 2 or 3% of the company, although he's retired some time ago. And that's a good sign, I think. And the management have, certainly for them, an awful lot of their personal wealth in the business. But it's a business which actually keeps on using the cash flow very well and doing bolt-on acquisitions. And they've now gone into the US, they've gone into Europe. They're big in the UK already, obviously they're big in Ireland, and they're in Scandinavia particularly. And it's just one of these wonderful rollouts where they keep on making good bolt-on acquisitions. I think we must have made certainly 5 times our money over that period, and it's still well set with a very strong balance sheet and lots of cash generation. So that would be one example of, I suppose, patience being rewarded.